Hello, and welcome to our webinar, More Effective Investment Decisions, the New Era of Technical Risk Reduction. Family offices are looking for scale and efficiency in investing, and they're leveraging tools and technologies to support them in their investment decision making. Today, our expert panel will give an overview of technical risk reduction tools and strategies that are scalable, minimize risk, and maximize returns. Let me introduce our panelists. Today, we have Dan Siciliano. He is CEO and co-founder of Nickel, a fintech that has invented a better way to invest in private unicorn companies. Alongside his entrepreneurial career, he was Stanford Law Professor of the Practice and Associate Dean at Stanford, and is a recognized expert in corporate strategy and governance, capital financial markets, technological disruption, and executive compensation. Dan is currently chair of the Council of Federal Home Loan Banks. Also joining us today is Sebastian Rivas. Sebastian is the founder and CEO of Andes STR, a prop tech company that leverages machine learning to help institutional investors invest in short-term rental real estate globally. Prior to leading Andes STR, Sebastian worked in AWS as a senior technical product manager. He has also worked in capital markets in investment banking and private equity. Just a little bit of housekeeping before I turn it over to Dan and Sebastian. Please ask questions at any time by submitting them into the Q&A box, and I'll be sure to share them with our panelists at the end, and we'll save a few minutes for questions. With that, I'll turn it over to Dan.
Great. Thank you, Kathy. And Sebastian, right off the top, I think we have to admit that what we're going to do in this very shortened period of time is we're going to throw out all the traditional definitions, because if you're getting a PhD in any of the great business schools of the world, and or maybe if you have an MBA, depending on who taught you your micro econ and or your capital markets class, you might have a notion of what technical risk reduction means. So do us a favor and throw that out the window. Forgiveness to all my former colleagues and my dear departed friend, Roman Wheel. We're going to dive into the super practical. So what we mean by technical risk reduction, and Sebastian, I'll kind of queue up some options for you to expand on this. What we mean is using specific tools that might be data, they might be AI, they might be narratives that go beyond anecdotal and constitute, substantial trends, and using those in a very particular way to reduce the arguably volatility of the underlying asset in which you're investing. Or at the very least, again, getting a little bit casual with our notion of risk and volatility, reducing the chance of surprises. Now, most of the time, we're going to assume you're investing long in these asset classes. So bear with us as we make that assumption. If there's any real outlier that requires us to remind you that maybe you would be short as opposed to holding it for an increase in value long, I'll point that out. But let me kind of kick us off with an example. So one of the things that people tend to do, especially in our space, which is, again, the venture capital space, late stage venture capital funded companies that are still private and above a certain size. So $1 billion in market cap or last valuation. It's not really a market cap since it's not freely traded. We call them unicorns. Most investors think about scanning the survey availability of all the different companies and then saying, I like this one, I like that one, I like this one. And then they go from there. And there's a lot of methods and strategies. Now, if you're the actual VC or the lead VC among many investors, and at that stage, it might include a lot of institutional investors, then you might engage in a lot of other work that, quote unquote, reduces risk. One of the examples we're going to throw out is the process of using criteria-driven deselection or exclusion. In other words, if you have the good fortune of having a large universe of target investments within a certain class, one of the ways that if you can use data properly, that you can, quote unquote, technically reduce risk is to have a criteria-driven analysis that then says, I won't invest in anybody who has or doesn't meet the following criteria. So we call that exclusion or elimination based on criteria. So I'll come back to that. But Sebastian, is there something similar in your space around properties? And remind us again, you're not a long-term rental investor. You are a much more strategic investor in properties and manager of properties for the purposes of short-term rental. So what about your world? Do people just pick what they like, or is there a way to avoid certain assets and deselect or eliminate?
Yeah, absolutely. So, well, in the world of short-term rentals, and for the benefits of anybody who doesn't know what exactly short-term rental is, basically any property that is rented out on a short-term basis. So more colloquially known as Airbnbs. Basically, that's just one platform, but Airbnbs. So there are one of the beautiful things about Airbnbs as an asset class per se is the asset itself is the same, right? It's the same house you would normally rent out to a tenant, whether you rent it out for Airbnb or any other type of scheme such as just long-term rental. We very like when we're setting up a thesis on what property would perform best as an Airbnb, in effect, what we're doing is exactly this: is we're excluding properties that we think, for whatever reason, and those reasons depend on each market, the performance increase between the alternative, which are long-term rentals, and the short-term rental is just not enough. So I'll give you a very simple example. If you were to rent out a property to a tenant in Orlando, Florida, for instance, what most people look for, what drives their willingness to pay, is proximity to good schools and basically proximity to Whole Foods or Costco and things like that, right? Like local points of interest. And that will drive your rents, basically. The closer you are to good school, the more kind of higher the rent you can charge. And there are a lot of multiples and a lot of trading rates that you can look in the markets. Now, if you think about now as an Airbnb, if you're a guest on Airbnb, do you particularly care being close to a school? Probably not, right? Mm-hmm. So generally speaking, what we do is that we exclude in our criteria, we exclude properties where the long-term rental rates are driven by factors that do not matter for short-term rental tenants, right? And what that does for you is you're basically grabbing properties that are properly priced, that basically have lower long-term rents because they're not close to schools, but where Airbnb tenants or guests are willing to pay more because maybe they're next to Disney, right? So that is a way we do.
I like that. I had actually not anticipated that answer at all, and so like I want to expand on that a little bit, which is you've identified a portfolio of potential target assets, and what you're saying is you're deselecting on a particular basis, which is premium assigned to the asset for attributes that don't matter to you, right? So you're gonna exclude a premium asset that checks a bunch of boxes, near a great school, very quiet neighborhood, whatever it might be, right? That is a normal premium for a version of that asset, and you're gonna cross it off because you don't want to get caught in a premium situation that doesn't give you returns, right? Exactly. And so I really like that. That's almost what I'll expand on the nickel side. Which is a definitional issue. So for any asset class, even alternative asset classes or hard to get into asset classes that are highly desirable, and we've got a good example going on right now, kind of in the technology space, individuals, companies, venture capitalists will try to define that particular company, in our case, as falling within that hot, highly desirable asset class. So unicorns are a writ large desirable asset class. Everybody wants to be unicorn. So one of the things that you can use as a criteria-driven deselection or elimination process is false attributions into a particular definitional category. So as an example, in the unicorn space, we would deselect, for example, any company that achieved its unicorn status on its first funding round. Because it's sort of fishy, right? Like truly your valuation at the time of your funding round, there are so many levers to pull in venture capital that, at Heroic Ventures, my old partner, Matt Robinson, and I used to joke that just for fun, we should do an early stage seed investment and turn the company into a unicorn. You could give them $100,000 and you would say, but you're worth 1.1 billion, right? It's just that we've got 150x liquidity preference. Like you create all these silly things. So that's a deselection or elimination criteria, which is suddenly a unicorn because it falls in the category of trying to be in a category that's hot through perhaps inappropriate means. So we eliminate any company that doesn't actually have a product, even if they're a unicorn, because that sort of doesn't count. We eliminate any company that doesn't have any cash flow. We eliminate any company that hasn't raised a substantial amount of money. So in other words, unicorn is a pretty good proxy for this idea of mature, having achieved product market fit. So we have in our head what that means, but we have a list of things that mean you get crossed off. So that's kind of our version of it. And it really, just to give you a sense of what that does, we have a deselection criteria of like 17 active items, then a few other different items. So jurisdictions matter. So at any given moment, certain regions of the world will be eliminated. Certain categories of product might be eliminated. So for example, at the moment, biotech, there's a lot of reasons for why that is. Often it has to do with super sophisticated investors that might bid up the value, right? So those kinds of things, we go from say 1,500 different unicorns down to probably an eligible subset of less than 300 just through the deselection process. So it's kind of a big deal. So let me shift gears. So within this kind of approach, we've got this data-driven, criteria-driven, elimination. Another traditional category of de-risking, at least broadly and technically, is to diversify. So anybody who's taken any econ class, undergraduate, MBA, anything, law school, I hope, probably, will understand diversification, generally speaking, right? But before I go into kind of slightly technical, can you give me an example of where diversification does and does not show up in your industry?
Yeah, absolutely. So it's actually funny. If you look at there's quite a few examples, but if you look at an institutional investor's portfolio, for instance, within real estate, very often they extremely often they are not very much exposed to short-term rentals, for instance, right? Because if you think about real estate, and if you believe that the short-term rental almost as an asset class is significant within the economy. I mean, in the United States, there's 1 million short-term rental listings nowadays, right? So that's enough to make a dent, right? Like it's an actual significant thing. And there are different drivers for that drive the returns for short-term rentals and for long-term rentals. So therefore, a sophisticated investor should want to have that type of exposure. If anything, because again, the cash flows that you would see and for a short-term rental and for a long-term rental, and what are the drivers, how does it correlate with other indicators like the markets, for instance, unemployment, etc. They're different, right? So that's one area where we don't see much diversification at a macro level. But another one, which is very important, is at a micro scale. If you were going back to Orlando, where we have a lot of data, if you were to look at the average cap rate 6 months ago in single family homes as a long-term rental, that would be 3.8, 3.9%, something like that. Let's call it 4%. If you look at the average short-term rental cap rate, so the first one was single family homes, then the next one is average short-term rental for single family homes is like 4.3%. But now, if you can pick those pockets where the premium between long-term and short-term rental is big enough, or between short-term and long-term rental, really, in those pockets, which are very easy to identify if you have the right data and the right technology, which is what we do for a living, in those pockets, you find cap rates around 6.5%, right? So it's a very, very big spread. So in a sense, what I'm saying is diversification for diversification's sake is not always good, interestingly enough. You got to know when and where and what is it exactly that you're diversifying, right? Is there any negative correlation between things, or is it adding any downside to your overall portfolio's performance if you add X or Y? And it's not always the case.
Yeah, and let's back up and be super clear, right? So this is, I guess, the first big picture piece of advice within this diversification strategy is to acknowledge that this is diversification after you didn't diversify, right? Like, so you are purposely, in the case of Nickel, you are investing in large private technology growth companies, right? And really, you can probably narrow it even more. In your case, you are investing typically in, family homes of a certain type with a certain number of bedrooms, certain number of bathrooms. So once you have that is the strategy, which is focused. I think the mistake not to make is then don't give up looking for diversification within that. And I want to highlight something that you passed over so quickly that people may not have picked up on it. You have a built-in diversification strategy in terms of cash flows, right? Relative to long-term rental, you have one tenant, maybe for a year, hopefully for 2, maybe for 3, but it's one tenant and they have a fixed sum that they pay you each month probably, right? Well, in short-term rental, you have diversified away from what we might call singular tenant risk by having a lot of different tenants across time. Now, that means any given tenant may be exceptional. They paid ahead of time. They left tips for your housekeepers. And maybe another tenant is so-so. They left it really messy. They didn't leave a tip. And, you had to, get after them to make sure they pay the deposit or whatever, right? But you have 30, 40, 50 tenants across any period of time. And that's its own kind of diversification, including, problems that occur, say, if the economy slumps. Well, you can adjust prices for next week's tenant or the week after that and get revenue. Whereas for a long-term tenant who suddenly can no longer pay their rent and leaves, then there's no diversification. So that's a built-in type of diversification. On our side, what happens for Nickel is that within any given cohort of technology companies, you want to try to achieve, and we do this bespoke for institutional clients and some for family offices, we might build 5, 6, 7, 8 companies into a given special purpose vehicle. And within that, because of how we get access to these unicorns to the employees, you might want to have 1 or 2 or 3 employees from any given company, participating with us in order to do what we do. And so that achieves its own type of diversification. And I guess, let me summarize where we've gone so far. So first, you can use data in a sophisticated way to have criteria-driven exclusion. So remember that, and then using that, you can go from a large universe to a much smaller universe of eligible investments. And that process acknowledges that you may not know the thing that makes a winning hand, but you can eliminate the things that tend to create a losing hand. And so that's an important process. And then you can diversify even after you've chosen not to within a subcategory. One of the interesting things to keep in mind on diversification, so as a reminder from undergraduate and graduate school, so there's systemic risk and idiosyncratic risk. And just to remind us, like idiosyncratic risk in a given company is that that company's CEO has a scandal and it hurts the company and it damages the company. That's idiosyncratic. Like that, you kind of didn't see that company as coming and it was only about that company. Systemic risk is the market as the whole slumps. There's a macro problem in the economy as a whole and demand falls. And so everybody in that category, performs poorly. So you can get away from and diversify away from the idiosyncratic risk because chances are if you have 5, 6, 8 companies in our situation, you're not going to have all of those CEOs have a scandal at the same time. There's not going to be an earthquake in their headquarters or whatever it may be. Same thing for you. Obviously, a portfolio of houses, even in the same zone, the same strategy, bad luck with plumbing or bad luck with a given client is going to be much reduced. Okay, so let's see. We've got a couple questions going in. Let me see if I can adapt one of those. So one of them is, what, from our family office portfolio among tech, how do you think and view the right level of diversification? So this is a complicated question. I'll pose the question for you in a real estate side too, Sebastian. But so from a technology investment viewpoint, here's the challenge with trying to be, other than the 10 or 12 dominant investors in venture capital who ultimately achieve, decent holdings of unicorn investors. So you could probably name them in your head, but there's really only 10 or 12 global investors that have what you would really refer to as a genuine portfolio of more than, say, 15 or 20 unicorns. If you aren't in that category, if you are and you're watching this, great, thank you for joining us. But chances are you're not in that category. You might be a small pension fund, you might be an ultra high net worth individual, you might be a family office. You can't easily get into by buying on the secondary market, or heaven forbid, funding 100 companies that then end up being 10 Series B and then 1 unicorn, maybe if you're lucky. You can't get into enough companies. Really, at a true diversification level within the segment, it takes anywhere from 15 to 20 different companies to get rid of most of that idiosyncratic risk at a kind of true unicorn level. And that's a very broad generalization. One of the few ways you can do it without having $1 billion to spend across 5 to 10 years is by entering the cap table later, rather strategically. And again, that's what Nickel does, because we work with employees in a compliant way, where if they have vested options, we can work with them in a way that doesn't violate any of the agreements and is super tax optimized. That's why they do it. We give them capital, they exercise those options, they have shares, and we put it kind of wrapped in a contract, wrapped in a trust. And over time, when those shares become liquid, in exchange for getting that capital advance, which saved them so much in taxes, they actually end up at the liquidity moment sharing a portion of all of the upside with the investors. And so it achieves these 30% plus IRRs. But the advantage here is that this is something that works for almost all unicorn employees who have vested options, which means you can select from the 100 to 200 to 300, depending on risk preferences of the not eliminated unicorns that we went through in our process. So on your end, Sebastian, what constitutes enough diversification? Is that kind of automatic if you have a decent sized portfolio?
Yeah, it's a funny question. So I would say I'll twist the question around a little bit, which is when it's too much diversification, such a thing, right? And I think there's two instances. One is when you, for the sake of diversifying, you're adding other risks than otherwise you would not have had. And in short-term rental space, the most typical form is regulatory risk. So let's say you're investing only in one city, let's say again, Orlando, where regulatory risk is severely mitigated. And now let's say, well, I don't like that. I want to invest in every major metropolitan area in the United States. Well, if you're adding San Francisco, if you're adding Los Angeles, if you're adding New York, well, now you're adding regulatory risk, and a pretty important one, right? So that's one where I'd say it's actually not really serving the purpose of diversification, because sure, you're diversifying one type of risk, let's say geographic risk, but you're adding another risk that is actually worse, right? That adds more downside to your portfolio. And the other one, when it's too much diversification in a sense, is when you're, by diversifying, you're letting go of any type of alpha that you otherwise would have gotten through either exploiting some sort of inefficiency in the market or through the use of better technology or data, which is kind of what we do for a living. We're basically saying, this market has limited downside, it has increased upside, you should get exposure to this market. Like you should try to get exposure to this market and maybe this other market that has a similar dynamic. But if you dilute away from this market, now you're effectively letting go of that alpha, right? So I'd say that those are the two common mistakes that we see when people are thinking about diversifying in the short-term rental asset class.
I think that makes sense. Part of what you highlighted, the regulatory risk, is sort of an elimination criteria. You don't want to go to New York because it's got too much regulatory burden and just hurts you. And then your point is a good one, which is diversification is a component of a strategy. It is not the strategy. In fact, it can blow up your entire overall strategy if you focus only on that. And then finally, I think it's worth mentioning two other things before we wrap. Apart and separate from elimination criteria as a strategy, and then diversification as appropriate, you also want to, and this might sound very obvious, but I think a lot of private assets or illiquid asset classes don't go through this process. You want to buy cheaper rather than more expensive. I know that's crazy. It's buy low, sell high. Yes, it's true, but it actually can't just happen. There has to be a technical process. So in our case, we run a process which essentially is a sort of reverse Dutch auction that identifies the reasonable, appropriate, but lowest price available for any given unicorn shares. And we use valuations from there. And so we have a process that drives low prices, but is still fair to the unicorn employee because of how the tax advantage works. And I assume you, Sebastian, do the same thing in terms of, for every 10 or 15 houses you might identify as appropriate. If the price isn't right, you just wait for the next opportunity. Is that true?
Exactly right. We actually benchmark again, using technology, we benchmark every property that is listed for sale in a specific market. It's over 3,000, for instance, in Central Florida a month. And then we set a hurdle. Like, since we can benchmark this, we say, you know what? Any property that's below the top 5% in terms of returns, we just don't even look at. And if it's in the top 5% every month, then you can de facto assume it's a good deal, because top 5% of the properties are usually good purchases.
Right. No, that makes sense. And the final thing we'll throw out there is, and we mentioned this in our prior series, but you can take whatever you have as an investment, and if you want, you can then wrap it in a derivative structure. So Nickel, by definition, does that. We actually have a prepaid variable forward contract that we engage in with the employee. It creates this structure that creates a lot of downside protection. This is a decision on our part that facilitates tax savings, creates some arbitrage, does a lot of good things. I want to mention one technical component of derivative structures. Derivatives are not a bad word. They're derivatives all over the place. During the great financial crisis, they kind of derived a little bit of a negative and sometimes a very negative connotation. But I want to point out something important, which is one of the risks of a derivative is that you need to assess your counterparty risk. And so in the great financial recession, it turned out a lot of the counterparties who were like, sure, I'll take your $10 million. And then if your collateralized debt obligations kind of go south, I'll make good on the following criteria. And it turned out they didn't have the ability to do that. So in our case for nickel, the derivative structure is simply with the employee counterparty. And so those shares are there. They exist by definition. They're, wrapped in a contract, put in a trust, validated. And so there's no counterparty risk in that sense. Is there any sort of derivative structure that tends to pop up in your space, or is that something that is not as common in the real estate side?
Oh, there is actually, again, by construction. So basically the way we see investments in that, the reason we even evaluate the long-term rental rents when we're underwriting properties is in a way that's limiting your downside risk, right? Because if you buy a property as a short-term rental, you start deriving higher yields because of the higher cash flow. And for some odd reason, there's some downside. Let's say regulations change, and now you cannot do legally short-term rentals anymore. Well, in effect, your downside is not zero now. It is a tenant, right? Now you switch your counterparty, and now you have the local risk or the local return as well from long-term rents, right? So it's exciting. Like the financial profile is that of a good a good structure, because you get the upside of higher yields, but the downside is limited by the local rents, right? So you get the good without the bad.
Yeah. And then you have lots of other things that we don't call derivatives, but they are, right? So a security deposit is a derivative, that the tenant is made good on. Insurance, casualty and fire insurance is a derivative that pays out under. So your industry is kind of rife with derivatives that have been around so long we don't call them that. But I assume that there's a smart way to do those and a not as smart way. And it involves quite a bit of technical analysis about deductions and amounts and market demand. And that's all stuff I know you guys do using all sorts of cool technology. So let me summarize that piece, which is derivatives as a part of layering in, and de-risking or enhancing returns, or a little bit of both on any given investment strategy. It's not a bad word. It's not a bad thing. I think the things you want to look out for are, is it compliant? There's always tax implications. Make sure that you've got solid, tax advice. Does it have counterparty risk? Well, an insurance company isn't real counterparty risk. The way you set up that free option for long-term tenants, there's no counterparty risk there. Same thing for nickel. The shares are real. They exist. They're, executed by contract. So these are kind of the things that differentiate it from those old, collateralized debt obligation hedges that were paid to, Cayman Island hedge funds. And then when everything went bad, maybe they didn't work out. So let's maybe finish off with the summary, commentary about Andy's STR. If people want to find out more, we've been talking about it, hinting about it, but we didn't really say what you can do with it. And then I'll do the same for nickel, and then we'll wrap up.
Absolutely. So at Andy's STR, what we do is that we help institutional investors invest in short-term rental property, right? And so we do this using a combination of two things. First is our proprietary machine learning and AI solution, which has won awards worldwide, that in effect identifies and analyzes every single property that is listed for sale in the market. We benchmark it, and we see whether the spread between the long-term rents or the long-term returns you can get and the short-term returns. And by short-term returns, I mean not in the short term, but by using short-term tenants, so Airbnbs basically, if the spread is big enough. Since these assets are priced using the long-term rental rents, you're basically in effect getting free alpha, right? You're getting, for the price of X, you're getting 2X the cash flow, right? And if things don't work out, you still get 1X the cash flow. So it's a pretty neat way of doing it. And then we have a fully in-house one-stop shop solution where we take care of everything, right? Like we do the property management in-house, and that's one of the ways we get a lot of data, right? Etc. So we provide access to investors to this asset class.
Great. And for nickel, we provide opportunities to invest in the asset of unicorn technology companies, and even the companies that are very hard to get into. If you're seeing this videotaped a lot, much later, it's June of 2023, and OpenAI is the thing that everyone wants, but no one can get, but we can get, right? Because they have, they have less than 500 employees, but almost all those employees have options, many of which are vested. And so we provide a way for those employees to exercise their options once they're vested, to optimize their taxes, convert what would be ordinary income tax into long-term capital gain. There's a huge gain for them from that. And in exchange for that, in exchange for getting that capital, we get a meaningful size piece of the upside, which, by the way, is still not as expensive to that unicorn employee as all that tax saving. So it really is a sort of, tax arbitrage, and everyone wins in that story. And all you have to do is be a little bit patient for these companies to become liquid, either IPOing or otherwise. And we can get access to almost any of the unicorns that survive our elimination criteria, because we don't want to invest in ones that are too risky. And at any given moment, we are, and these move pretty fast, spinning up a special purpose vehicle, which might have 3, 5, or 8 unicorn companies in it. It might be $5 to $15 million. It's very opportunistic for that moment in time, getting great values. We have a fund, which is a broadly diversified fund, which is on a rolling basis, putting money into unicorns. And then, of course, on a bespoke basis, especially for family offices that are trying to balance their portfolio diversification, we can put together special purpose vehicles just for them that maybe target 1 or 2 particular companies or a set of companies that offset their other investments. So at any given moment, we can do that. If you're interested in that, certainly do contact us. Well, Sebastian, we've covered the other version of technical risk reduction using a handful of our methods that I think is generally applicable, but super fun for us. So we'll end there. Thank you for taking the time to chat, and thanks for those folks who submitted questions. We got to a few of them, and for the ones that we didn't get to, we'll certainly send out answers. And with that, we'll just end with the information about the companies and ask you to reach out to us if you'd like to. Thanks a lot.
Very much. Bye.